Before we start, I'd just like to say a quick thank you to our podcast sponsor, PensionBee, who are one of the UK's leading online pension providers. Now, PensionBee can help you transfer most of your old pensions together into one simple and low-cost plan, all through their app and online platform. Now, if you're looking for a low-cost, hassle-free way to consolidate your pension pots, except final salary pensions, that is, then PensionBee is worth considering, especially as it does not lock you in with exit penalties, which I really like. That's because it leaves you free to move your money at a future date if you so wish. I think it's a combination of investment fund performance, low costs, and its slick app interface, which has been integral in PensionBee gaining over 250,000 customers and receiving an excellent rating on Trustpilot from over 1,800 reviews. Now, you can sign up with the names of your old employers in 5 minutes. PensionBee's plans are managed by the likes of BlackRock, State Street Global Advisors, Legal & General or HSBC, and as always with investments, your capital is at risk. For more information, go to pensionbee.com.
Hello and welcome to episode 263 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leakes. Damien, how are you doing? You're back.
I'm back. So I had a brief break last week, and I suppose I was tempting fate, wasn't I, with the previous podcast where I sat there and said, well, we've got to try and avoid the coronavirus. Now, I don't know that I've had the coronavirus, but I almost was ill immediately after recording that podcast and was basically laid up in bed for the best part of a week. So yes, I'm back, and so that's why I was missing last week, just like everybody else out there trying to carry on as normal. But unfortunately, sickness will hit us all at some point, so I was slightly unwell, which leads on quite nicely to this week's podcast, because we're trying to be a bit sane. We're trying to give a voice of sanity. So you guys out there listen to us every week. And with the country almost in lockdown, it's not officially, by the time this podcast goes out, who knows where we'll be. But we're trying to, with this week's podcast, give people a sense of perspective in life, on particularly the investment front, and then some advice on bits and pieces to do with their money in respect to the coronavirus outbreak, which Andy's going to do that piece, aren't you, Andy? And I'm going to
That's right. Yeah.
focus more on the investment side of things. So yeah, it's good to be back, but like everybody else, I think we all got to be mindful of trying to put things into perspective and try and get away from some of the hysteria, social media rumours, and to be honest with you, I think we need a break from the news a bit, and that includes the investment news I'll come on to. So should I just fire away and we'll kick on with the investment piece? Because I'm going to do an investment piece talking generally what's happened with markets, just to explain things and hopefully make people feel a bit better. And then Andy will talk about some of the stuff to do with the coronavirus and your finances. Things like what you can do to try and reduce your bills and things, and bits and pieces like that, because there's been announcements by different firms. So investments. Whew. I mean, if you've been watching the Damien's midweek markets, you will have noticed that it's been an epic is an understatement, couple of weeks. And what we're living through now is probably the worst period for investing, certainly since the financial crisis, arguably ever, because we've entered a bear market at the fastest rate on record. Now, when you look at the charts, normally a bear market, so that's when the market falls 20% from a recent high, it can take a while to unravel. It will start to go down, you'll get a rally, it will start to meander, and it can take usually, well, there's a whole range, but let's say a year or more, just until you get to the point where you get to a low. And what we've seen is, in the space of 3 weeks, is the bottom fall out of markets. And if you've been looking at your portfolios out there, you'll probably be sitting there panicking, and you'll be looking at your portfolio and going, why is it going down basically every day relentlessly? And the answer is we've entered a phase of this sell-off that is inevitable when it's a severe correction like we've got, partly because of the panic. So what tends to happen, it's almost like the pattern of a sell-off, that we had a very orderly sell-off at the beginning. So for the first, say, 2 weeks until the beginning of March, the things you thought would do well, so that's defensives, gold, bonds, maybe some of the defensive equity sectors outperformed some of the more cyclical ones. It was very orderly, so you were protecting your portfolio in the usual fashion. Then, after the first few days of March, something happened. And that thing that happened is the bond market collapsed. And we're still in the throes of that. But what happened is the spreads on, so when they talk about spreads, it's really looking at the, say, US Treasuries, which are the safest type of bonds out there. So that's what the government borrow money. So you effectively lend to the government when you buy things like gilts or treasuries. They're really the safest assets out there because the idea is they're not going to go bust. The yields on those started to rise, which it seems to be counterintuitive. When equity markets are tumbling, you'd expect people to be buying treasuries. And when the yield on those was rising, the yields on the higher yielding stuff, so corporate bonds, so the loans to companies, were really blowing out. So you were starting to get bond markets collapse at an even faster rate than the treasury market. So corporate bonds going worse than treasury markets. So I used the analogy in the Midweek Markets podcast, and I'll use it again because I know not everybody listens to the show. But if you imagine investment markets are a skyscraper. So at the bottom are the low risk assets. So it's cash at the very bottom and the foundations, and then it's things like treasuries, then going up to corporate bonds. And as you go further up the tower, you get to things like equities and the higher risk assets. When there's an earthquake, then the stuff at the bottom will move less, but you'll always get the wobble at the top. If you ever stood on the top of a really big building on a windy day, you can actually, if you look out the window and look down, you can see the building move slightly. It's slightly disconcerting, I'll give you that. But if you ever get the chance, do it. But it's meant to. Because I think even the Shard, I may be wrong, some engineer will probably write in and tell me I'm wrong, but I'm sure the Shard actually floats on a bed of something like mercury or whatever to allow for the movement in buildings because of its size and because of the wind. But what happens is if you get the bottom part of the building start to shake violently, it will collapse because the foundations go, and so the top part will be moving even more so and the building will fall down. That's what we had in bond markets, because when the reality of what the equity markets were pricing in, which is a economic collapse, a recession, when it started to look like we're closing down whole countries and we had companies starting to immediately run out of money. Let's look around you. Restaurants are closing. Cinemas aren't able to open. Small businesses are starting to fold. You're seeing even other retailers on the high street close their doors. Corporate England, so the businesses in England are struggling. And of course, when they struggle, the first thing they will probably do is default on all their debts. So the corporate bonds, which is effectively loans to companies, will start to be increasingly go unpaid. And so the credit worthiness of companies starts to weaken. And when that happens, bond prices fall. So you get this scenario where there's a rapid repricing of bond markets, because all the cheap money that was out there through QE, low interest rates, built an equity bubble, but also a corporate bond bubble in a way. And so there's been a rapid repricing of that. And so bond values have tumbled, and you're seeing bond funds fall like 2, 3, 4% a day. That's not unusual in the last 2 weeks. And so when you look at your portfolio, if your equities are falling like that every day, volatility at the moment means the VIX, the VIX that I talk about, that is at a level where you're expecting to see at least 4 to 5 percentage point moves every day for the time being. It's up in the sort of 70 and 80 range, the VIX. We need to be back down towards like 20 to be anywhere near normality, and we get normal daily ranges and swings in markets. So we're getting the similar thing in bond markets. So it means you're not having nowhere to hide. Gold is experiencing the same thing. We're seeing gold, I think it's down about 12% from its recent high at the beginning of March. And the reason this is being compounded is because of something called hedge funds or risk parity funds. When these huge funds are now being forced to liquidate assets, people are trying to pull their money out because they're panicking about equity markets. Then what happens is they start selling the most liquid things to meet the redemptions because they don't have enough cash. So that will be things like bonds and treasuries because they are able to convert them into cash. So we're then getting this feedback loop where those funds are selling more and more of their liquid assets, the safer assets, to fund redemptions. More people are seeing the values plummet in those funds, so they're therefore pulling out more and more money. And you kind of get this doom loop going on. And it happened in the financial crisis. I mean, the reason the financial crisis was slightly different because it was obviously centered around the banks. This one is much more centered around, it's obviously the health of the population, and it's not caused directly as a result of bank excess. But it's the impact is starting to be very similar. So we're seeing now bond funds tumbling. We're seeing huge withdrawals from bond funds across the world that are in excess of what we even saw in the financial crisis. So the message is that I'm not trying to scare people, but we are in the period that has to happen in order for things to get better. So we're at the point where everything is going wrong and going down at once. So gold is being liquidated by these funds and investors. There's a dash for cash, and in particular, it's the dash for US dollars. So if you look at the US dollar, it is soaring against anything. If you didn't realise that the pound has tumbled from about $1.30 to about $1.16 in a matter of days. So that has a benefit for your overseas equity holdings or bond holdings. But if they're tumbling, then you're not seeing that currency boost. But it's there, it's happening, but you just don't see it. So for people listening to this, we are at a point where we are getting near mass panic, and that is more likely where we're going to start to see a bottom happen in investment markets. Now, equity markets always bottom before the economy does, because they're discount mechanisms. So they discount on the way in, so they collapse before the economy does, but they tend to bottom before the economy has actually bottomed in its collapse, because they start to discount what's going to happen in the future, and they start to think, well, the economy is going to pick up, and so people start buying assets again. So what we want to see, just to give people some markers, have a look at the VIX. We need to see that come down a bit towards 20. We want to see bond funds stabilise and stop losing money hand over fist every day, because at the moment cash is king in any low risk asset. It is at the moment in any asset. But particularly when you're looking at bonds, if bonds aren't doing what you want them to do, then cash is beating them.
And when you talk about cash, for beginner investors, this is where you pull the money and you literally sit it in a pot in your platform or whatever that says cash. You're not putting it into assets, right? And it's just sitting there and it can't make money, but similarly, or well, some you can make small amounts of money, I think, but similarly, you're not going to lose money. You're just kind of riding it out, right?
Yeah, and I'm not telling people to cash out of their investments.
No.
The point is that when you're in the complete capitulation phase, then cash is the only thing that's going to protect you. Because at the moment, bonds aren't doing it. There will come a point where they do. Now, the message is that the markets could go much lower. They still can. We're down probably about 40% across the board on equities. And you're looking at some bond funds and stuff down 20%. We could still go lower. We did in the Great Depression. There's a danger that we could be looking at markets like that. If this is more like 2008, then we might not have much further to go till we get towards the bottom. But bottoms are seldom points in time. They're often processes. And by that, I mean that this can take some time to improve. So what you're likely to get is an incredible bear market rally at some point. So you're going to get the market rally. And when I say rally, it's not just by a couple of percentage points. You could get it rocket 20% up in like a very short space of time, because you always get these rallies, bear market rallies, and some people call them bear traps within bear markets downtrends, as people then rush back in because they think we've hit the bottom. And that process of rallies, sell-offs, rallies, keeps going until we get this recovery. In the past, that recovery can take, to get back to where we were, typically around 200 trading days or 140 trading days on the S&P. 200 trading days is the one I've quoted before on the Dow Jones. If you go back to 2008, to get back to where we were before, it took 5.5 years. And that is assuming you stay in that's just looking at like the S&P 500. So if you just stayed in an index, and that's the price level. But when you've got to obviously reinvest dividends, it's slightly shorter. But you're going to end up having rallies during that period. Just to give you a steer, the S&P recouped about half its losses within a much shorter space of time, probably a year after they hit the bottom. Then the rest of it took a bit longer to play catch up, and then you recoup the rest of those losses. So where we are at the moment is keep an eye on that VIX, keep an eye on the bond markets. If you Google LQD, that's a corporate bond ETF that's in America. And when we start seeing that pick up, I think you're going to start being near the bottom. Because in the financial crisis, if you go back and look, that bottomed and then started to rally. At the same time, the equity markets sort of achieved the first bottom in the back end of 2018. Equity markets then rallied, then sold off again and hit their lowest point which was a bit lower than where they were at the end of 2008. They hit their low in March 09, but what it did is it showed that the bottom was almost in. So if we start to see that rebound, and another one is if you type in HYG, that's high yield bonds as an ETF. If you start seeing that making some really impressive moves higher, then we could hopefully think that the bottom might be coming or in near market. And the other thing to bear in mind, when people say like the bear market rally, what could you get? If we would get the bear market bounce from here, then, I mean, the FTSE 100 is about just above 5,000. You could see it bounce up towards about 6,500 at an extreme rally. That doesn't mean that it will keep going higher, but it could bounce up to that sort of level. And equally with the S&P 500, we are at a level now which is around the lows that we achieved in December 2018. So the sell-off and the low was on Christmas Eve. So we're back at those lows. We're testing those lows. It's almost like a resistance level. And the market is showing signs of life around that. That doesn't mean we're not going to go suddenly crash back down through it, but they're trying to bounce from there. And if it managed to bounce, we could see the market bounce to 2,400, 2,500, even 2,700. If it breaks lower, then we could be going down towards 2,100. So with the so you can see the S&P is around 2,400 at the moment. So there's quite a swing we're looking at either way. So we're not out of the woods by any means. But the one other thing I want to quickly mention to people is to put this all into perspective, that right now in the world that we're living in, the losses that you have on your investments are paper losses, and they become real once you crystallize, but they're paper losses, and you're not going to get the bottom of the bounce. That's the other thing. So if we all panic and pull out, then the market will rally and you've just crystallized losses and you won't get the early stages of the recovery. But we have to realize that there are more important things in life. As long-term investors, we have time and patience on our side. So we can just increase our time frames and we can be patient, and then things will at some point start to recover, because they always do. The other thing is, I want people to realise that what's going on in their bodies when they're looking at their investments. Now, if you keep looking at them, what happens is your body is doing that fight or flight scenario. Your stress levels are rising. You're reading the news every day about what's going on in investment markets. The adrenaline is being released. Your body reacts in a very particular way. And that fight and flight mechanism works in a way to try and save you in the wild. And that starts to narrow your field of vision in a way, and your sense of perception of what's going on. It makes you focus intently. But what it can do is it can adversely increase your stress. So a good example is you could be reading about what's going on in investment markets, looking at your portfolios, and you've not even noticed your kids have walked in the room because you're so getting caught up in what's happening that is going to be a point in time that you're forgetting everything else that's going on in the real world. And that's a sign that your stress levels are increasing around your investments. And it also is a sign that you're going to make a decision that's going to be impaired. Because what happens is you don't notice the positive stuff that goes around on the periphery. Because at some point, there will be peripheral positive news that you're not noticing. Because you're only focusing on the negative stuff that's going on. So you focus on that. The peripheral stuff you don't notice because you're so tunnel visioned. And that peripheral stuff is when we start to get a recovery starts to take shape in terms of the economy, in terms of investment markets, in terms of your own portfolios. But you won't notice it because your physiology will stop you from doing so. So the message is, try not to get bogged down about what's going on at the moment. If you are in a position where you have got, you're a long-term investor and you've got a time frame, as you should do, of 5+ years, 10 years, then you've got time to recover from this. And the one thing I always like to say to people, it's not this one you want to worry about, this collapse. It's going to be the one after or the one after that. So in your pension fund, you're going to see a lot of these, experience a lot of these collapses. So I remember being in the city in 2008. I remember it very vividly, the swings. For a lot of people, this is new. They've never seen this before. But this is part of the journey. This is part of the surfing. You've got to get wet. You can't surf if you don't get wet. And at some point, you're going to get a bit of a wipeout. But things will inevitably recover, as they always do. And we will have another crash. When we come out of this one, we will already be building towards the next one. So do bear that in mind, that you're going to have a number of these in time. The market will recover. It will go to new highs. It will always do. That's what happens. And then there will be another one of these crashes because they are periodic. And just put that in mind. If you have that long-term view, that starts to make you feel a little bit more, hopefully, sanguine and realistic about what's going on at the moment. So hopefully I've made people feel a little bit better about what's going on. Put your phone down, stop reading all the investment news, start to enjoy a bit of time with everybody else, family and things like that, and just put all of this into perspective, because there are far bigger problems that we've got out there at the moment than our individual pension funds.
One of the things that I'm reading and hearing about from investors is almost like a state of people kicking themselves, people saying the warning signs were there. I was reading about what was happening in China. I should have moved into cash. I should have seen this coming. And almost, I don't know, a sense of I've done this to myself. I've caused this by not taking action. What would you say to those people?
Well, the thing is, black swans are black swans, so you couldn't necessarily see it coming. And we've had periods like this where markets looked like they were going to collapse and they didn't. And buying the dip obviously worked. Hindsight is wonderful, but the one issue you do have, if you realise, just imagine you cashed out, right? You cashed out ahead of this. So at the moment you are sitting there laughing because your portfolio is probably worth 20-30% or whatever more than it would have been had you been in where it is now. At what point do you buy back in? So the point would be when we are sort of max fear. But what will tend to happen is those people will likely sit on the sidelines almost for the entire duration and then go back in when they feel the coast is clear. At which point the scale of their paper wins will be greatly reduced. So I don't have an indicator that will guarantee when to get back in. So what happens is you may have been smart and got out, but at what point do you get back in? Because each day the market goes down, your fear is going to increase that you're going to make the wrong decision. So I would say try not to kick yourself. It is one of those things. It's inevitable. It's going to happen to you again unless you can predict the future. And so, yes, it would be great if everybody exited. The signs were there. We talked about it on 80/20 on midweek markets. But the people who did pull out, that is fantastic. But the reason that this one has been so quick and so violent in terms of the sell-off is because of the lack of information that's out there. So they don't really know what we're battling. We don't really know the impacts of things. So we're now at that knee-jerk stage. And so that is something that is you couldn't have predicted. So I don't think people should beat themselves up about missing out, because at the same time, when will they get back in? Those people who often shout about their wins like that, they're sitting in cash at the moment. When do they go back in? Because I tell you what, they will not get the bottom as well. If you can get the top and the bottom, then you are a genius and you'll be on a desert island. I can guarantee you the people who are crowing because they were at the top may have got that, but they haven't had any of the upside from the previous years anyway, so they've missed out. And those people were sitting on the sidelines for years. What do you think they will do in the coming years when there is an inevitable recovery? They will sit on the sidelines again. And that's fine if they don't want to invest and they're bearish, and people shouldn't let the lessons of this sell-off go to waste. It might just prove investing's not for them. But people who are just sitting on the sidelines in cash have made no money for more than a decade. So what we've seen is people lose a lot of the profits they've made over the last few years. If markets rebound from here, then hopefully they can start to sort of recoup some of that.
Sensible stuff. Good. Well, it's a strange pod this week. As you said at the start, we're going to be the voice of reason in this podcast. We're not going to mention the dreaded C word too much because people hear too much of that already. But it would be remiss of us not to cover a few of the top money topics that people have been talking about and try and cut through the noise and give proper advice from the real sources that are out there, and just pick out the key things that people should be aware of if they might be struggling over the next couple of months, as I'm sure people are. So should we go into that now?
Yeah, let's rattle through that, because I'm conscious of the length of the podcast, and I've just noticed the time. I did a Facebook Live because I felt like people needed to hear a voice of reason and just ask questions. And I've just looked at the time and I'm running late. So hopefully you've all enjoyed the Facebook Live in the Facebook group. If you're not part of the Facebook group, do go and join facebook.com/groups/money to the masses. We're going to be doing more and more in there. And I'd just like people to share their sort of questions, fears, because there's a lot of it's a very fast-moving environment, but Andy will rattle through this section. So what's up first?
So first and foremost, Let's look at the banks, because the first people you should really be contacting is the banks in times when you might be experiencing a loss of income or a lower income. And so what help is there out there from the banks? So we've actually pulled together a really helpful guide that we've put on the site, and we'll be updating it. Well, we've said daily, but to be honest, as and when things change, we'll be updating it. So it could well be updated hourly as things progress. So looking at the banks, the top UK banks have all made statements, and they're trying to help people out where they can. So I'll rattle through a few of the examples. I won't give you all the information. Go on the website, go onto our article. We'll link it to the Facebook group so that you can see that as well. But just to give you an example of what the banks are doing at the moment, Lloyds have come out and said that they're going to charge no fees for any missed payments on credit cards, loans and mortgages for the foreseeable future until we know what pans out. They're going to offer payment holidays, as the government has already said that they're going to basically impose that on lenders. Lloyds have confirmed that they will be doing that for the people that are affected most. Emergency access to savings will be given in fixed term savings accounts, and you won't be charged for that. And they're going to increase deposit limits online so that you don't have to walk to the bank and expose yourself. So that's Lloyds. And to be honest, that's the general theme of things with a lot of the top banks. Some banks haven't gone as far as others, but again, check out our article to find out. Interestingly, First Direct have gone one stage further on the mortgages, and they've actually said that they will allow people to contact them if they're experiencing hardship with a view to potentially changing the mortgage rate, which is unprecedented, really. They're saying that people can do that during their mortgage fixed term, potentially to change to an interest-only mortgage. You'll need to speak to your lender to find out what the rules are on that, but it's worth considering that if you are going to be struggling.
One thing on that, Andy, I just want to mention on mortgages, because obviously the Bank of England has been whacking the old panic buttons, and central banks globally have, and we're now down to 0.1%, I think it is, on the base rate for the Bank of England. So we've brought it in. I mean, we're up at 0.75% previously. And so if you're on a tracker mortgage, then if it's one that's linked to the base rate, you could expect to see your mortgage fall on a monthly basis. Do be aware, though, that some will have lower limits, so you won't necessarily get all of that passed on. If you're on the standard variable rates of lenders, then they won't necessarily pass everything on. They don't have to. So you have to make sure you check your T's and C's, particularly if you're on a tracker mortgage. So it's unlikely we're going to see more interest rate cuts unless we end up negative. And the Bank of England don't want to do that. So it's one of those things to bear in mind. If you go and Google online, there's plenty of calculators that show you how much your monthly mortgage payment should fall by. If you Nationwide have one, that when now rates have been cut, how much you will be better off a month. There are people who might be interested in, therefore, refinancing their mortgages because rates are falling. Now, interestingly, the best fixed rates aren't dropping yet as a result of these emergency rate cuts. And that's partly because margins were pretty thin for these banks anyway. And what with the announcement of mortgage holidays or payment holidays for 3 months, I think they're trying to reassess what the impact will be for them. And so at the moment, they're not necessarily creating any new, cheaper fixed rate deals. And I think if you look out there are a number of lenders actually pulling their tracker products because they don't want people to be on them, and they're obviously worried about their margins. So the mortgage market is an interesting one. Like Andy said, there is that payment holiday, 3 months payment holiday ruling that they've put out there. But you've got to check with your own lender, because at the moment, I mean, I've heard mixed messages from different places about the lenders that are actually up to speed with all of this and actually allowing it to happen, and also the impact on people's credit rating. And so in the past, there's been differences of how it's been applied and credit rating agencies notified, and people who've had holidays in the past, payment holidays, have seen it negatively impact their credit rating. So you need to make sure you get from your lender what will happen, because you won't obviously want to take a holiday unless you really need to. And of course, that sounds obvious, but most people shouldn't really be doing that anyway, unless they really need to take a mortgage holiday. So that's lenders. What about bills, Andy? I know there's some people doing some interesting things on bills.
Yeah, so if you're going to be struggling paying your bills, then it's important to understand your rights and what sort of help you can get. So first of all, council tax. if you're going to struggle to pay your council tax, get in contact with them as soon as you can. They can offer payment plans, they can spread the payments, they can offer payment holidays potentially, and it's one of the bigger bills. So get in touch with your local council as soon as you can, and they will be able to help you with something. They've confirmed that they will be offering people who are suffering as a result of this support, so make sure you do that. Now, going on to your water bills, legally they can't cut you off. Your supply can't be cut off, but just because you can't be cut off doesn't mean to say that you should stop communication. The first thing you need to do is contact your water supplier and say that you're struggling. We've actually got Lauren in our office who's actually worked for a water company, and she's given some really good advice on the article that we've done. Essentially, they will help you. They will come up with a payment plan. In some cases, even paying just as little as £1 a month while this is going on until things recover, and then you can reassess things and start to ramp up your payments to make sure you can catch up. There is help out there. Utility bills in general, energy, the government's coming together and speaking to all the utility companies, basically trying to improve legislation to say that you can't be cut off. Now, with electricity and gas, it's not what they would consider a sanitary sort of need. So in terms of your electricity and gas, you can still get cut off legally, but the government are changing legislation so that that can't happen while this is going on. And if you're on a meter, there is help out there for you as well. If you can't get out to top up your meter...
You mean a prepayment meter?
Yeah, like a prepayment meter, there is help out there as well. Contact your supplier, say that you'll be in self-isolation. They'll be able to make sure that you can get a continuous supply, and they'll work out how that you end up paying for that. They may be able to send top-up cards or keys in the post to you, and they're open to more discussions on that. So don't feel like there's no help out there. Just get in touch. That's the key message on this.
Yeah. And the last few pieces that are quite useful is like people like Sky TV are allowing people to pause their Sky Sports subscriptions because obviously there's no sport. So there are things going on out there from different providers where you can get in contact and you can pause them. Their gym memberships, obviously, there are a lot of people. I'm one of these people. I'm apparently going to be a high-risk group and might have to be in lockdown for 3 months. Then pausing your subscription on your gym membership is a good idea. And some of them will actually allow you to do it without any minimum payment. So like some of them might say you have to pay £10 a month. They might allow you to do it without minimum payment because if it's for obviously medical reasons. And the other thing is if you are traveling or you commute and you have a season ticket, you may be able to get a refund on your season ticket if you're having to work from home for the foreseeable future. And just to wrap this one up, I think there's obviously you're going to be working from home, then there are some things you can claim because you're going to obviously incur some additional costs by working from home. Now, there are two main repayments that can be covered. So you can get a £4 a week or £18 a month fee from employers to cover costs, but you can be reimbursed for actual costs incurred, which include things like additional heating, insurance or whatever. So go and look on the .gov.uk website. There's more information there, but it's fairly minimal unless you're going to keep all your bills in. Like I say, it's going to be a small amount, and for most people it's probably going to not make much of a difference because don't forget this is all about using things for the exclusive use of running a business. So you're not doing it, you're just at home for a period of time. But there are some things you can technically claim if you want to. So go and look at the .gov.uk website.
And just one final point, while we're talking about looking through your bills, working out how you can save money, try wherever possible not to make a knee-jerk reaction on your insurance. Please check your insurance, what you're covered for before you cancel it. That's all I'll advise you. Look through your direct debits, find out what it is, speak to the insurer and work out what it is you're covered, because the last thing you want to be doing in times of crisis is cancel insurance that will actually protect you in the future. So just be mindful of that.
Oh, actually, that's a really good point Andy's raised there about insurances. So the FCA came out and started to gave guidelines to insurers about treating customers fairly. So about things like you being at home more regularly because you're working from home. They're not allowed to wiggle through T's and C's to say that you're working from home and therefore it invalidates your insurance, for example. So they're not allowed to do that. In terms of life insurance, obviously most people it'll be just the same. If you've got life insurance in place, like Andy said, then you should be fine. Just keep paying the premiums because obviously there will be unfortunately some people who will die from the coronavirus. But some of the insurers are going to start to try and change their ways of doing business. We've already seen it in America, where if people take out insurance policies, they might delay the start of them almost in a kind of quarantine way. So you do need to speak to insurers, particularly like health insurance, because with the government now perhaps using private health hospitals, then it will impact some of the benefits that you'll be able to enjoy on your policies. But the key thing is the FCA and the government are aware of all these issues, and they're putting out guidelines that people need to be treated fairly going forward, and that includes at renewal. So they're actually putting out guidelines to insurers about when you get to renewal, whether companies need to be able to make a policy still available, not just start cancelling policies that people had just because they don't no longer want to be exposed to the risks associated with the insurance. So that's something to bear in mind. So the message is, do speak to the companies you have insurances or anything with, but do not necessarily change anything. The government, it's a very fast moving environment we're in, and it's almost like as soon as something pops out, something goes wrong, the government or the regulators are trying to sort of push it back in, and then something else pops out, and it's going to be a lot like that for a period of time. So try not to do anything too knee-jerk.
Excellent. So for more information, keep an eye on that post that we've got on the website. We'll put a link in our Facebook group. And don't forget, we're coming to the end of the podcast now. If you haven't watched Damien's Facebook Live, which ironically he's just about to record, then make sure you do, because it was brilliant. You're really good, Damien. Well done.
Thanks, apart from the fact that I'm already 10 minutes late. Anyway, so thank you for listening this week. As ever, you can contact us. Please leave a review. We like to be the voice of sanity and reason during these periods of crisis. We've lived through something similar with the financial crisis back in 2008. We will survive this, so please try and be as positive as you can be, and also do get out a bit more. Do go and spend some time, well, when you can, within reason, following government guidance, I have to say,
in some nice open spaces.
Yeah, but do try and keep your sanity levels and mental health up. Okay, that is it for this week, so until next time.